Good morning, everyone, and welcome to Julius Baer's Moving Markets podcast. It's Friday, the 20th of March, and my name is Helen. My first guest this morning will be Jan Bopp, and he'll be giving us a roundup of what we saw in financial markets yesterday. And I'm also joined by Thomas Caflisch this morning, who'll be filling us in on the latest moves in FX and metals markets. But first up is the market news. Good morning, Jan. Thanks for joining me.
Good morning, Helen. Thanks for having me.
Let's start with the mood across markets because it shifted quite a bit throughout the day yesterday. Through European trading hours, it felt like another risk-off session. Oil surged, equities fell sharply, and bond yields jumped. But then volatility eased. Can you tell us a bit more about what happened, please, Jan?
Yeah, it was a real whipsaw session. Markets were on edge in the morning after oil prices spiked on the back of the Iran-Israel-Qatar escalation when Israel and Iran attacked major energy facilities. But sentiment improved later as comments from Israel Prime Minister Netanyahu crossed the wires. He said Iran had lost the ability to enrich uranium and manufacture ballistic missiles and suggested the war could end a lot faster than people think. He also said the nation will no longer target energy infrastructure, a big relief. Meanwhile, US President Donald Trump told reporters he's not putting troops anywhere after being asked about the possibility of deploying ground troops. Also big relief for markets. US crude touched highs above $119 earlier in the day, but in post-settlement trading, it fell back to around $95. That's quite a round trip. Also for equities, the S&P 500, which had been down nearly 1% during the day, clawed back most of its losses to close only 0.3% lower. The Nasdaq also ended down 0.3% and the Dow Jones lost 0.4%. It was still the second consecutive losing day for all three major indices, but the late day comeback was notable.
European equities had a much tougher day than in the US, though, right?
Yeah, I mean, the improvement in sentiment came just too late for European stock markets. The stock 600 closed 2.4% lower, with every major sector down except energy. Miners were hit especially hard. The sector dropped more than 4%. Gold and silver plunged as well, down more than 3%. I mean, gold was trading above $5,100 an ounce just a week ago. This morning, it's trading just shy of 4,700 last time I checked. And volatility throughout the day was massive. Silver fell more than 10% at one point.
It would probably be naive to call the improvement in sentiment anything more than fragile. The broader energy market continues to feel the strain, which of course is having an impact on inflation expectations. There's a lot of talk again about stagflation, meaning elevated inflation together with weak growth.
And that's precisely why bond markets had such a shaky day yesterday. 10-year German bonds traded above 3% for the first time in 18 months. US Treasuries sold off hard early in the session. At one point, 2-year yields spiked to nearly 4%. They recovered quite a bit into the close, ending at 3.8%. But the message from bonds was clear. Investors worry that central banks might have to tighten policy again if energy-driven inflation persists.
And in Europe, yields also moved sharply. 2-year UK gilt yields registered their largest rise since 2022, up 31 basis points, after the Bank of England said it stands ready to act against inflation.
Yes, and the ECB, well, it kept its deposit rate unchanged at 2%, but also here, the central bank struck a very cautious tone. Officials stressed that the scale and unpredictability of the conflict could push inflation higher in the near term and depress economic activity if oil and gas disruptions persist. That's exactly why there's talk about stagflation. Markets are now pricing in more than 2 hikes by the ECB this year. Not cuts, hikes. That is quite a change compared to where we were at the beginning of the year.
And let's have a quick look at market action overnight and also to the day ahead. What are we expecting today, Jan?
There's another wildcard for today, the massive options expiration. About $5.7 trillion in notional value is set to roll off in what traders call triple witching. These events tend to amplify volatility, considering how jumpy markets already are. Today could be lively. So far, Asian equity markets are fairly quiet this morning, which can only be a positive thing at the moment. Other regions are mixed. Chinese equities are lower. A slump in shares of heavyweight Alibaba weighed on the market overnight. The Chinese tech giant's stock lost more than 6% in Hong Kong after it reported sales that missed estimates. So the Chinese IT sector is under pressure this morning. And US futures, well, they are trading around flattish.
All right, plenty happening then, so maybe not a day to step away from the screen early today. Thanks very much, Jan, for the great roundup this morning.
Yeah, thanks for having me, Helen.
And now over to you, Thomas. Good morning, firstly.
Good morning, Helen.
The conflict in the Middle East is obviously also having an impact on currency markets, right?
Absolutely. While the immediate effect is on oil prices, that quickly ripples through global currencies, particularly influencing the dollar. Right now, this situation is arguably the dominant driver in the FX market. If crude oil remains above $100 per barrel or climbs even higher, we should expect continued strength in the US dollar, which naturally affects every other currency worldwide.
And where exactly does this link between oil and the dollar come from?
There are two key reasons. First, oil is globally traded in US dollars. So when oil prices go up, more dollars are needed to buy each barrel, increasing global demand for the currency. Second, the very factors pushing oil prices higher, geopolitical tensions or concerns about supply disruptions, are typically the same conditions that make investors seek safety. And historically, one of the safest havens in times of uncertainty is the US dollar. So you get a double effect. Stronger fundamental demand for dollars combined with risk-off sentiment.
Okay, given all of this then, where do you think the US dollar goes from here?
Well, that depends entirely on how the situation between the US and Iran unfolds. And frankly, nobody has a clear answer to that. Geopolitical developments like these are unpredictable. As long as tensions persist or escalate, the dollar is likely to remain supported. But once stability returns, we could see a reversal. Until then, volatility will probably stay elevated.
Now, we had Carsten Menker on the show yesterday talking about precious metals, because usually with so much uncertainty, we'd expect things like gold to rally, right? Acting as a safe haven. But we're not seeing that this time. What are your thoughts on the moves we've seen in gold recently?
Yes, that's right. And intuitively, gold often shines during crises. But interestingly, we saw the opposite, especially yesterday. Gold declined dramatically despite rising tensions. It's hard to make out a single cause, but my best interpretation is that many leveraged speculative long positions in gold were suddenly unwound as broader financial markets came under pressure. When equities or other assets start selling off rapidly, investors sometimes liquidate parts of their investments where they are in profit to cover losses elsewhere. Additionally, the Federal Reserve message last Wednesday may have played a role as well. While they held rates steady, officials hinted that the next move could just as easily be a rate hike as a cut, an unexpectedly hawkish tone. That depressed bond markets, pushed yields higher, and made holding non-yielding assets like gold less attractive. But still, this kind of pullback isn't unusual in turbulent times. Once forced liquidations ease and sentiment stabilizes, there's good reason to believe gold could regain its footing fairly quickly.
Okay, and just quickly on the topic of central banks, because this has been a busy week, anything noteworthy that you'd comment on, Thomas?
Not really in terms of decisions, but definitely in market reactions. 14 central banks met over the past few days, and most kept policy unchanged. The notable exceptions were the Reserve Bank of Australia, which raised rates by 25 basis points to 4.1%, and Brazil, which cut theirs by 25 basis points to 14.75%. At first glance, it seemed like a quiet week on the rates front, but beneath the surface, expectations shifted dramatically. Just at the start of the week, markets were pricing in around 28 basis points of total easing in the US by year-end. Now, that number has shrunk to 0. No rate cuts are expected anymore in the US. Meanwhile, in Europe, the expectation at the beginning of the week was for a 25 basis point hike from the ECB. Today, the market is actually expecting a cumulative 63 basis points in hikes until year-end. And even the Swiss National Bank is expected to hike rates by 30 basis points by the end of this year. So, while the headline said no change, the story underneath was one of significant repricing across global fixed income and FX markets.
All right, very interesting. Thank you, Thomas, very much for joining us this morning. Hope to speak to you again soon.
Thanks for having me, Helen.
So that is all for today. Thank you again to my guests and thank you all for tuning in. Please subscribe to our show if you enjoy it, and you can, of course, also leave us a review on whichever platform you like to listen on. So we'll be back again on Monday morning. Do join us then, when I'll be back, joined as always by more of our colleagues to talk about what is moving markets. But until then, I wish you all a great day and then a great weekend. Bye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.